Tonight on NBC, Jimmy Fallon and Bozeman St. John host the incredible new competition show.
I hired 10 creatives from all walks of life. They will be battling it out to see who can impress the world's biggest brands.
This is a huge opportunity.
This is the battle for the next big idea.
This is not play.
We're spending millions of dollars.
I'm so excited to embark on this adventure with all of you.
May the best idea win!
On Brand with Jimmy Fallon, tonight on NBC.
Reality radio for a really great future. We're talking real money.
What in the world has happened to the world? You know, it used to be shooting wars only broke out between countries or lawmen and gangs of criminals. Now it's delivery companies.
That was funny. It's not funny, but
it's not funny. You got an Amazon driver shooting a postal worker.
I know.
Turf wars.
Wouldn't you think it'd be the other way around? Wouldn't the guy be going postal on the Amazon guy? I don't know. That's just my take. But
it's a whole new world. It goes whichever. It
upside
can go
down.
It's so unexpected. Hey, got a question for you. You guys, you want to talk? You want to talk? You want to talk about money? Money talk? That's what we do. It's called Talking Real Money. And you can talk with us about money if you call 855-935-TALK, 855-935-8255. I'm Don McDonald, along with Tom Cock. And today marks the beginning of a new quarter. Gosh, I hate the end of the quarter shows. I just hate them. And you know, it's funny. The world, again, another quarter has passed, and the financial world didn't end again.
No, it got very close a couple of times, but it hung in
really?
there. And no, it really didn't. No, just listen to a few of these. It's fascinating. When you go back and you consider, I think I have this right. Not that long ago, we were still talking about continuing inflation, right? It's like it's not it's down a little bit, but not going down the way they hope. That was one. Right. Then we, from what I read, it's the worst job market since 2009. Unemployment's low. But finding a job apparently is very difficult.
Trust me,
that's what I hear.
I can tell you from personal anecdotal
you got fired from this gig?
No, my daughter, the dear thing.
Your daughter, and she's qualified for pretty much anything because she's just smart.
It's hard to find a good job these days.
And then, of course, we have the overhang still. And remember the tariffs? Wasn't that going to be a kind of a big deal?
Oh, there was another one. Trade wars. I forgot about trade wars. But they're not shooting wars. Yeah.
And then the third quarter happened. U.S. stocks up 8%. Emerging market stocks, the riskier part, like Brazil, India, China.
Yeah, I've heard of those.
9.6%. 9.6%. Bonds up a little bit. By the way, I'm sure were heavily invested in this. Silver up 29%. That was the best performing either index or currency or commodity. Yeah. You know what the worst one was?
The worst commodity?
Chocolate lovers are going to rejoice. The worst.
Cocoa prices went down?
By 28%.
You actually checked commodities prices?
I go through all this very carefully. As you know, I get up early. I check the numbers.
Did crypto go down yet?
No, it made a little bit of money.
Dang.
The S&P 500, by the way, up 7.8%. It goes on and on and on. Growth stocks a little better in value. You get the point. But here's what you maybe didn't get. Because you forget. I mentioned some of the things that people were nervous about because they call and they ask us and they say, what should I do, et cetera, et cetera. So to get those returns, which, by the way, now year to date, I think I gave you the number. The 100% stock portfolio is up 15%.
And that's 100% global stock portfolio.
Global stock portfolio.
The G word is an important part of that.
It's very important because some of those asset classes, groups of stocks, international small cap value stocks up almost 39% now year to date.
Wait a minute. What about that argument that so many made with us in the past few years? Well, I don't need those international stocks. They haven't done anything.
I believe, out back sucking wind right now. So, okay, but to get these returns, here are the things you needed to do, right? To make this money. Number one, you had to be invested.
Okay, that's
a lot of people are still either not or they're waiting for something.
Yeah, we hear from people. I'm going to get in when the market feels better than it does.
That's right.
Yeah.
Number two, you had to be diversified because I mentioned emerging markets was actually the best group of stocks in this last quarter. All these other asset classes have had humongous years. You want to be there. And here's the part that's the hardest for most people. We know that, having talked to you, and you can call us and talk about it right now. You got to learn how to tune out the noise. All the garbage that's out there, we could stack it up. We could go weeks with that stuff.
Including the noise that Tom just shared with you. You need to tune out all of that recency. The quarter...
Can we rewind it?
The last quarter doesn't matter, except as an object lesson in this case, and it merely as an object lesson this time, that says, all of you... And, there was a review on Spotify that said, I wish Don would quit calling people stupid. Well, quit being stupid. If you weren't being stupid, then I wouldn't have to call you stupid. Reason I call you stupid is because so many of you, and you know who you are, you said to us for the past several years, I'm not going to invest in small cap. I'm not going to invest in value. I'm not going to invest internationally because those U.S. growth stocks are the big winners. Now, when it's time to get in, I will. Did you know it was time?
No.
Like 3 months ago?
You didn't switch. You didn't know that. You got to be in those all the time. All the time. So, yeah, it was a great quarter. You're right. Nobody knows what the next quarter, this quarter we're in, fourth quarter, of course, means. But it's already been a phenomenal year for stocks and, frankly, for bonds. The intermediate term government bond index, well, not index, but intermediate term government debt at Dimensional up 6.3% year to date. I knew I'd get that out there eventually.
It's been a good year.
So sell it all and lock in the gains?
But chocolate.
Trust me, it's been a good year for me with chocolate. It's I'm holding up my end of the sides.
I just watched the latest episode of Great British Baking Show, and it was the chocolate episode. Tom, you've got to watch it. Your mouth will water. I thought of you when I saw that.
Eating it. Oh.
So much chocolate. 855-935-TALK is our phone number. We do have lines open just for you.
Tom and Don are talking real money.
Hi, Don McDonald here. So, what's your plan for retirement? No, really. What's the actual plan? Because hoping the market goes up, stockpiling random investments, and praying your gut instincts are smarter than Wall Street is not a plan. It's a guess. And when the market gets bumpy, and it always does, guessing leads to second guessing. And second guessing leads to panicking. That's why you need more than a portfolio. You need a purpose, a strategy, a real financial plan built just for you by a 100% fiduciary advisor who's legally obligated to act in your best interest. Imagine that. Start your plan today with a free, no-pressure meeting at TalkingRealMoney.com or call 800-386-3004. That's TalkingRealMoney.com, because your future deserves more than crossed fingers and wishful thinking. By the way, no sales pitch, no obligation, just smart help for real people who want to stop guessing and start planning. Appella is an SEC-registered investment advisor. See AppellaWealth.com or the firm's Form ADV for more details.
Your guides to a really great financial future. Tom and Don are talking real money.
Excuse me, I had a coughing
You
fit.
okay? You gonna be all right?
I'm okay. I'll survive that one. This is the show that's all about your dough. The Talking Real Money Show. I'm Don McDonald. Give us a call if you have a question about money at 855-935-TALK, 855-935-8255. In addition to that, though, a lot of you send your questions in at Talking Real Money on the contact form. Some of those get typed, and then they end up over there with Tom, who's hogging them, I think. But he's going to release a few.
I know. Before we do that, though, I just want to mention a few of the things that got really slaughtered in the third quarter.
Oh, you have
slaughtered?
I didn't know you had slaughtered things down there.
Yeah, the Argentine peso. Argentine peso lost 12.7%. It had been one of the better performing assets. Wheat down 4%.
It's not an asset. It's a currency.
Oh, thank you. And then this is the part that the real slaughter occurred. Lean hogs down 9.3%. So that's really sorry about that.
So basically slaughtered in more ways than one.
I was going to leave it at that.
Yeah.
Do you want a question? Is that why you're pointing at me
bellies. Here? Well, yeah, I thought you said you had one.
Oh,
I
have
just
some.
following your lead from the break.
Wow.
When you went
Finally.
like that, and I thought, yeah, that must mean he has a question. And then I threw it to you for the question, as is my wont to do, and you decided I'm going to do something completely different.
Boy, you really pulled in about 9 different shows there.
Exactly.
Chad from Seattle says, love the show. Hope you might advise folks that, contrary to conventional wisdom, if you can make a few percent on your money, you're better off taking Social Security at 62 and investing it yourself. Motley Fool did a study that shows just 3% gets the break even into the 80s, 4% into the 90s, and 5% to 105. And one doesn't need to invest the Social Security anywhere in the portfolio will do. I don't know what that means. So spend the Social Security, leave your 401k alone, and grow for many years. Am I wrong?
I think you're wrong.
Yeah, I went. So here's what I did, by the way, because every year before retirement, I go look at everything new I can about everybody who writes about Social Security. And there's a lot of people that write about it because it's a very complex topic. And please don't call and say, what about this? It's very hard. But in this case, taking the money early, and I would call 62 early. That's the earliest you can take it, right? And then investing it somehow. There's a couple of problems with that. Number one, you could have a period of time where stocks don't make any money, depending on how you invest this money. That would be one. Number two, again, basically, and from full retirement age to 70, 100%, you get an 8% a year raise. There's not very many things that I can guarantee you can invest in that are going to make 8%. And number three, as I started to say, I can't find anyone who I think you should listen to who writes about Social Security who says this. That says, yeah, you're going to make more. And I tried to find the Motley Fool study and couldn't find it.
No, I couldn't find it. But I sat down. I just did some basic math. Okay. So let's say your 62 amount is $1,400 a month. And this is relatively close. 62 is $1,400 a month. Claiming at 70 is $2,500 a month. That's pretty darn close.
That sounds about right. Yeah. Okay. Yeah. Okay. Sure.
So if you take that $1,400 a month at age 62 and invest it until you're 70 at 3%,
so 8 years,
which is what he just said, 3%.
Yep.
You would have about $116,000. If you that would add, then if you start taking and spending your Social Security, that's going to add about $500 a month to your Social Security.
$6K a year. Yeah, okay.
So basically the break even from what I calculate is right around 81, 82. If you live longer than 81 or 82, you're better off waiting.
It is a bet, right?
It's a
Nobody
bet.
knows. Yeah.
But,
so we just had a friend pass away at 79.
And we've said this over and over again. If you expect or hope to live past your early 80s, early to mid 80s.
I thought it was going to be the other way around. You hope not
if
to.
If you did it at 7%, if you got if you managed over that whole time to get 7, then the break even moves into your mid 80s.
By the way, you have to also be disciplined enough not to spend the money.
Right. But putting that totally aside.
Okay. Sure.
What we have said over and over and over and over and over and over and over again that apparently people don't hear is you're better if you live longer taking it later. That's it. It's simple. The longer you live.
You need a 10-year period after claiming to basically make it work.
10.
You have to live till about 80 if you wait till
10
70.
to 15.
Yeah. So, and in my case, again, just to add a little complexity.
And it does add complexity.
My wife is a bit younger.
Is such a child.
Please. I know she's not listening.
No, she's
at
not
the Taylor
upset.
Swift thing.
She's not going to be. She's at Taylor Swift. She's not going to.
Yeah,
be
she's not. No, she's not.
And wait a minute. Speaking of a child.
Oh God, here we go. Yes. What? Which
Taylor
child
Swift
now?
Thing.
Oh yeah. Okay. Yeah. Well, she went with my daughter. So,
okay.
17.
She didn't go by herself.
They're still mad that they're not seeing Benson Boone tomorrow night at the.
Is that the guy they talk about in the Northwest News Radio commercial?
He grew up 5 miles from
in
here,
Monroe
right
or
down the road in Monroe.
Didn't he?
Yeah, yeah.
Yeah, I mean, I heard about him in the commercial for Comcast or Xfinity or something.
I thought he was just doing backflips or something, but apparently he sings too.
I don't even know who he is.
At any rate, so as I was saying, she will inherit my benefit.
Yeah.
The likelihood is she'd outlive me, right? And so if I wait and take the big one, which will be far bigger than hers,
yeah,
she'll get mine for a number of years. So when you double that, when you do it with 2 people, it really blows it away.
And as young as she is, she's going to get that big old honking benefit at 62 for the rest of her life until like 112.
Oh, God,
because she sucked
please.
all the life force out of your old
Well,
carcass.
that's a whole other. That's a whole other.
Your
story.
old desiccated
We don't
carcass.
have time. We don't have time for that part of the program today.
I'm stealing
Yeah.
your life force.
Yeah. Anyway, Chad.
I swear that's
Chad,
what women do.
Chad, this is so emotional for most people. We try to do is show you the numbers. People think we're going to take it personally when you say I'm going to take it at 65. You take it anytime you like. It's your money. Yeah. I'm just saying the numbers don't match what you're saying. That's all.
And the only thing is that we hope, because we want you to be right about it, so that we're hoping you die before 80. That made it worthwhile. I'm joking. It's a joke. 855-935-TALK.
Tom and Don are talking real money. For your real life and real future, Tom and Don are talking real money.
And we love talking about it with you. Talking real money with you at 855-935-8255. 855-935-TALK. It's free and it's easy. Oh, during the break, there was an ad for getting your flu shot or getting your vaccines.
I'm going to get COVID and flu.
I got my flu yesterday from the doctor.
Yeah. Mm-hmm.
Dang. It starts to hurt after a while. I forgot. Wow.
You big baby. I get
had
4 of those.
You know what I had
notice.
to do? I had to take some
Yeah?
Tylenol.
Oh, and guess what? No,
I know.
never mind.
Don't even go there. 855-935-TALK. Bail us out. Let's go to Burien. Michael, welcome to the program.
Hey guys, thanks for so much. You guys have helped me out so much over the years. Well, Don, you've helped me out so much over the years. Not
Wait
so much
a minute,
Tom. But
I think the call's becoming disconnected. What happened to Michael? Didn't we have him on here?
Thank goodness I control everything from my end.
Going back to listening to you years ago on what was it, Seattle Business News Radio or something like that?
Yeah.
Okay, now wait
Tom
for
that
historical
station.
fact.
Tom
I'm the guy who
programmed
put
that
him
station.
on the air there. So if you really want to get the credit, then
But
okay.
he was behind the
Might have been his
scenes.
voice. Yeah.
All right.
Yeah. Okay.
Very good.
He's
Very
a
good.
big
Anyway, I learned
baby.
so much from you guys early on. Yeah. Learned so much from you guys early on that
Thank you.
Been an incredible benefit throughout my life. And Tom, I will give you credit. Your son helped me quite a bit when I met with him for one of your free free meetings, and he
Finally did something.
You're ready
Good.
to retire. Yeah,
Finally did. I'm glad to hear
retire me.
that. That's great.
Yeah.
Now, all kidding
And your
aside,
retire
thank
me,
you. Thank you.
Your retire meet was fantastic. Got my sister to go to it recently. She just retired as a teacher. Anyway, my question is what I should do with some money I have sitting right now actually in a money market fund. I'm 64. I've got about $3 million in an IRA. I have no debt. I'm divorced, no kids. So I don't really need a lot of that money. I actually have about probably 35 to 40 grand a year coming in from a small business, and I've also got a rental unit. But bottom line is I just sold a rental condo, and so I've got about 300 grand sitting right now just parked in a money market account. I'm thinking I'd like to be very conservative with it, but I'm trying to decide, do I want to put that into like laddered CDs?
I'll let Don take that up.
municipal-
Yeah, I'll let you. But my suggestion right off the bat, pretty simple: either crypto, gold, or tulips. But let Don go from there.
Yeah.
And once again, proving just how much help he is. Mm-hmm. Wow, that was helpful. This doesn't come.
Okay, but you got to go back. I mean, always the purpose of the money, all the basics.
I guess before we get into my argument for municipal bonds,
which has got to be pretty strong now.
I'm telling you. Do you know how strong it is? Let me just the highest yielding CD, 1 year CD I can find right now is about 4.3%.
I was wondering, it hadn't moved much still.
So that means a ladder is going to yield you because they're not much different over the spectrum. You're going to be looking at about 4.2% over the portfolio. Real high safety, and if you keep the ladder, trick with ladders is it requires you to be very disciplined. You have to always just immediately invest that money that rolls over if it doesn't look like you're going to need it. That's where these bond funds that have these massively diversified portfolios start to look good, is for those who just want to just do it. And I'll take a little fluctuation. I'm not that concerned. I don't want 100% safety. But what's really interesting right now is BND, which is the taxable bond fund at Vanguard, the ETF, has a yield of about little under 4.2. The VTEB, which is the tax-exempt bond fund, which is just a whole muni bond market fund with a similar duration of 6 years.
Low cost,
3/100ths of 1%. Its yield is 3.5 U.S. tax-free.
So you could do the number there pretty easily. Yeah, there you go. So that's pretty hard to argue, as you said.
That puts your break even at below the 20% tax bracket.
Indeed. Yeah. Figure it out.
Right. Yeah.
So I think that's pretty hard to argue with.
Fund again?
VTEB.
What's the tax-free bond fund?
Vanguard tax exempt bond or VTEB.
EB baby.
Okay. Yeah. Perfect.
Basically, it's the first letter of every word in the fund. Vanguard tax exempt bond.
Exempt bond. Yeah. Mm-hmm. Yeah.
Perfect.
Good fund.
Okay. It sounds great. That's exactly what I was hoping I'd get from you guys. Hey, one last thing I'll mention real quickly, just for all the listeners. I mentioned this to you, Don, at the retire meet. This saying I read: while progress depends on pinning our hopes on a world that doesn't yet exist, those who cannot stop planning for the future are doomed to labor for a life they will never fully live.
Tom and Don are talking real money. Reality radio for a really great future. We're talking real money.
Hey there, welcome back to the Talking Real Money Extravaganza on the weekend, the show that becomes the podcast that turns into a show again. No, it only does it once. It only makes the transformation one time. It just goes from radio show to podcast, and then it stays there. I'm Don. That's Tom. Our phone number is 855-935-TALK, 855-935-8255. And now, let's head out east, way out east, to beautiful Scranton, Pennsylvania. And Tom, welcome to Talking Real Money.
Hi. Good afternoon. Thanks for taking my call. I appreciate it.
Thank you.
All right. So I've got a relatively quick question. So my wife was the executrix of my mother-in-law's estate, and one of the heirs to her estate was a minor, my wife's niece, and my wife is the trustee for the money that she left my niece, around, $40,000 or so. My niece is 4 years old, and the question became from her, and I don't know the answer because I only focus on retirement stuff, is, hey, where should she put the money? What type of an account should be opened up so that when my niece turns the age of majority, she'll have access to the funds for whatever she wants to use it for, not necessarily tied to, additional education, but, to make available for her at that time.
Yeah, that's a very good point. You mentioned education. So that would be one option. You could do a 529 and put, I think you can do all the way up to 40K in 1 year. I always forget the limits year by year. But that would be an excellent place if the money's designed for, paying for higher education. By the way, it also can pay for secondary education in some instances. That would be one route. The other would be just a regular old brokerage, or you'd have to do a Uniform Gift of Minors Act account. The money could move over there. And I think I had that right, Don? And then you could maybe split it, maybe half for education, half for something else the young person could use later on.
Yeah, here's the problem. The way the laws read is really uncertain on the 529 score because of the fact that 529s can be changed. You see, this
the beneficiary
money,
could be changed. Yes,
this money is absolutely.
So you may okay. Good point.
So you would have to get if the will specifically states that the money can be placed in a 529, that would allow it. The other thing that it would require probably the executor going to the court and getting approval for a 529. Otherwise, probably
money could go to somebody else.
It would have to go through a UTMA or UGMA account, Uniform Trust to Minors, Uniform Gift to Minors account, or that's really there are some
Those
other
are the
really goofy options
you make
like trusts and things, but you got to be really careful because the executor has very limited authority, and that authority must be in the best interest of the beneficiary. Now, if I can't imagine a scenario in which the money was placed in a 529 and it ended up going to that minor, nothing was ever changed. that anyone anywhere would ever be upset about it, because it would require going to court to get a ruling that that was a mistake. But it could open the executor up for some liability should that out there option happen.
Yeah, I think that's a good point. So either of the other two or the 529. And then, Tom, the easy part would be I'd just use one of the one fund. Well, if it's a 529, I use an age-based portfolio at Utah or somewhere like that. Pretty easy. But then with the Uniform Gift to Minors Act, I would just use a one fund AVGE or DFAW. Don shaking his head.
If it's for education, I would probably...
No, not education. No, but
what I'm saying is if it was still, you still wanted to gear it toward education in a UTMA or UGMA, then it would probably make sense to use a target date fund.
Yeah.
That is dated about the year that child would start college.
So another 14 years. So you'd be looking at 2040.
Yeah,
20 target date 2040, because then you'd be
2040, 2045,
split between stocks and bonds. Yeah, that's a good suggestion rather than all equities.
Right.
Gotcha. So let me ask you this. So I don't have experience in this. One of the UGMA or UTMA accounts, that's different than just a general custodial account for a minor. There's something unique about that.
No, it's the legal name for a custodial account for a minor. It's under two different acts, and it depends on the state. It's under either the Uniform Transfer to Minors Act or the Uniform Gift to Minors Act, depending on the state. And I don't know which it is for Pennsylvania, but it's one of those two. And then the custodian is named on the top line, custodian for the bottom line, and then the person for whom that adult is a custodian is allowed to take possession of that money at the age of majority. And again, that varies from 18 to 21.
Yeah, well, that's true. I don't know what Pennsylvania. Good point. Yeah.
Gotcha. And if there's any taxes associated to it in the interim, who does that get taxed to? Does it get taxed to the minor or to the custodian?
To the minor. Because it's owned
probably has a pretty low tax rate.
Yeah, it's owned by the minor.
Yeah.
Because it's for the minor's best interest. I'm pretty sure. That's what I've always been led to believe. But let me just check. They're taxable. They're taxable to the minors. Yeah, I knew that was the case. So the first $1,300 of income or capital gains from the account is tax free. The next $1,300 is taxed at 10% about.
So you're okay on.
Yeah, a lot.
40,000 then. Yeah, you're good by a lot.
Yeah.
Yep.
Awesome. That's perfect. Thanks so much. We really weren't sure where to go, and I said to my wife, I said, I'm going to call these guys, and they'll be able to guide us.
That's
try.
Very kind of you.
Not all the time, particularly with tax stuff, but we try. Thank you so much for the call, and thanks for listening. And for the rest of you, hey, that number, 855-935-TALK, 855-935-8255. And what are we here to do? Well, we're here to be talking real money with you, because the thing that matters most for us is that you understand what we're talking about, that you get it. We want you to ask us about the things you need to know about. That's why we make all of these incredible opportunities for you to ask us questions. Saturdays, it's calling 855-935-TALK.
Tom and Don are talking real money. Your guides to a really great financial future. Tom and Don are talking real money.
If you haven't figured it out by now, truly the only constant in our lives is change. Stuff will change. You just have to be open to changes and make changes as the environment shifts underneath you. And that means for investing that the folks who run money management firms need to be scrambling, and they are scrambling to create ETFs. In 1 week in September, regular old mutual funds saw a net outflow of $17+ billion.
I think it's $1 trillion this year, almost.
While ETFs saw an inflow of almost $29 billion in that 1 week.
Barcelonis writes at Bloomberg about this. The numbers are stupendous. The only thing that's keeping those mutual funds alive is the market's gone up, so that's helped keep some of their assets there. Now, some important things continue to happen here that you need to pay attention to. One of them is forward-looking companies like Dimensional Funds and Vanguard have said, well, how can we transition people, take their money from mutual funds, put it into exchange-traded funds without creating a big tax hit? Vanguard, did this process,
invented
right?
the concept.
They did, yeah.
And they actually had a patent on it, but that patent has expired.
Yeah. And so others have said, well, that's a pretty doggone good idea. You mean they could just be in the ETF wrapper and wouldn't have to pay tax to move the money? That's right. So last week, Dimensional Funds was given, what are they calling it? The exemptive relief, apparently before the SEC shut down.
Thank God they got in under the wire.
Yeah, they got in under the wire. To move 70. They're going to have dueling share classes, right? I think you can still be in a mutual fund, but also be in an ETF. With the other ones, I think they just one day moved everything over. Now, remember, this really does not apply to you if you have money in IRAs, Roth IRAs. It's not as important. In a taxable account, for sure, if you could get money out of that mutual fund into an ETF without a tax consequence, that is huge, because now all the things that happen inside there, basically, not all, but basically capital gains, you're not going to face that. It's a massive deal.
It's like a baby. It's kind of like a baby IRA. It gives you some tax
ways.
deferral in your taxable account if you use it, and it works best for growth funds because bond funds don't distribute much of the capital gains.
No.
But it means those capital gains defer until you sell the fund.
Yeah, it's a really good deal. So Dimensional's been definitely on the fore on this. I would expect to see we've already talked about this to some degree. Every mutual fund company is trying to figure out what to do because they're going to be left behind. I mean, they're going to be making the last buggy whip, right? Like we look really great. We have 80% of a market that's 3 buggy whips. So you're going to see more and more of this. You should pay attention to it, especially in your taxable brokerage type of accounts, and make sure that you're with a fund family that's going to do this in the future, because it's going to be, this is where we're headed.
Eventually,
I think you said it very well at the open.
Eventually, all of them are going to have to do it. They're going to have to. And eventually, mutual funds they'll go the way of closed-in funds from the past.
And how many of you are in closed-end funds? Raise your hands.
Unit investment trusts. Yeah, those were the big deals in the 20s and 30s.
Yeah.
And then they kind of went away as the industry changed, and the industry is changing. Give us a call. 855-935-TALK is our phone number, 855-935-8255. You can also send your questions in at Talking Real Money on the contact form. You can type them, or you can speak them.
Hi, Don. This is Connie from Wisconsin again. It is well known that prior to full retirement age, if you work and collect Social Security, you will pay either one of every $2 or $3 in taxes on your Social Security. I listened to several financial retirement podcasts and have heard many times that whatever Social Security money that is taxed due to earned income, you will get back after you reach full retirement age. But I have never heard how you get the money back. Could you explain in layman's terms how this money is returned? I'm assuming it's some complicated formula, but just wondering if you could give some insight on this. I have never heard that explained. Thank you so much, Don.
Bob.
Okay, you haven't heard it explained because it's not real.
Yeah,
it's not
searching
real.
The banks there trying to figure that out.
I know what she's talking about. If you take your Social Security while you're still working.
That's the thing. The age is not important. It's the fact that you're getting income.
Earnings test.
Yeah, correct.
So you lose some of your Social Security.
That's right.
If you're working. And then at FRA, when you retire, they adjust your benefit back up again.
Correct.
So you're not
so you're paying tax on your Social Security today, right?
Yeah.
Yeah.
Oh,
right,
yeah.
Because you're taking it. Right. You're paying tax on it.
But they don't just kind of give you money back.
No. When you get to basically now age 67 for anybody who's at full retirement age, you just get that adjustment. But it is not a return of the money of which you paid.
No, it's just an adjustment back up. Because remember, they adjust you down. Then you're taxed on top of that. The adjustment down, and then you're taxed on that.
Yeah.
But you don't get like free money at the end. Whoever said that was wrong.
Well, hopeful. They're optimistic.
Wrong. No, they're just wrong. There's a lot of bad information out there.
Especially on Social Security. Somebody texted me, by the way, when we were talking about it earlier and said the reason people are still, in his belief, wanting to take it early is they think it's going to run out. They're not going to get my money, whatever. I want to take it now and don't mess around.
That's a big reason. Yeah. Let's go out to Connecticut now. Susan, thanks for calling. Welcome to Talking Real Money.
Hey.
Hey, Susan.
Hi, how are you?
Good. What's up?
Hi. So my question is this. I don't have a lot of expenses. I have money invested. On top of that, I have about $250,000 in cash. And I'm looking at CDs. And right now it's sitting in a Fidelity premium money market.
All right. This is that question that we get a lot. So, Susan, hold on. We'll get to it right after this break.
Tom and Don are talking real money.
Hi, Don McDonald here. So, what's your plan for retirement? No, really. What's the actual plan? Because hoping the market goes up, stockpiling random investments, and praying your gut instincts are smarter than Wall Street is not a plan. It's a guess. And when the market gets bumpy, and it always does, guessing leads to second guessing. And second guessing leads to panicking. That's why you need more than a portfolio. You need a purpose, a strategy, a real financial plan built just for you by a 100% fiduciary advisor who's legally obligated to act in your best interest. Imagine that. Start your plan today with a free, no-pressure meeting at TalkingRealMoney.com or call 800-386-3004. That's TalkingRealMoney.com, because your future deserves more than crossed fingers and wishful thinking. By the way, no sales pitch, no obligation, just smart help for real people who want to stop guessing and start planning. Appella is an SEC-registered investment advisor. See AppellaWealth.com or the firm's Form ADV for more details.
For your real life and real future, Tom and Don are talking real money.
Well, let's see. Susan in Connecticut has $250,000. And Susan, it sounds like you're wanting to know what to do with it. Is that right?
Yeah, I want to keep it, some accessible, but most of it just, not making 2%.
Yeah, see, well, herein lies the problem. You can make more than that. You could go to high yield savings and make almost 4, actually over 4. I've looked it up recently. But that's going to be a rate that will change. Pardon me?
Yeah. I said that's going to change.
Yeah, what's the long-term purpose for this money, though? What do you want this money to do for you? Down the road.
Grow.
Yeah, grow.
I'm 73, so I don't really have a lot of, my needs aren't great.
Do you have any other invested assets?
Yeah, I have about $950,000 with an investment advisor, and then I have another, about another $300,000 that I've done myself.
Okay, what does your investment advisor suggest you do with this?
I haven't. Well, maybe he's not an investment advisor. Maybe he is somebody who invests my money.
Uh-oh.
You know what I mean? There's a difference there.
Yeah, so it's more like a stockbroker.
They sort of follow that.
Yeah.
Well, I guess they do better in bad years than the indexes. They do worse in good years than the indexes. They're value investors.
Okay, so they're money managers. Yeah. My suggestion, again, and we say this over and over again, is you're wandering blindly into through retirement. You have just this hodgepodgey portfolio, and you desperately need. You've got enough money to make this worthwhile. You have a complicated scenario. You really need to have a plan. You need a financial plan more than you need anything else financially right now in your life. You just keep it in a high-yield savings account for now and get a good fiduciary-only advisor. Fiduciary-only, that's not the people you're dealing with, by the way. And somebody who can say, well, these assets need to do this, these assets need to do that based on your need for income and your ability to take risk.
And once you have that plan, then you have the roadmap, and you don't have to worry about what this comes up. It's all straight ahead of you.
Plus, the roadmap tells you exactly where to put the money.
Exactly, which off-ramp to take. So you're all set. That's a bad metaphor, but you get the idea here that rather than us just saying, go put it in X, You really got to have the plan first.
In the interim, though, put it in the highest yielding, high-yield savings account you can find online. Go to bankrate.com. I looked at one. There was one for 4.3% that was FDIC insured. Put it there temporarily, but then make it a point to find yourself a true 100% fiduciary advisor. Absolutely fiduciary advisor. They don't sell products on commissions ever. Ask them that question. And then get a plan from somebody. Really get a plan. That will help you in the future. Yes, ma'am?
Would they charge, could I do that by the hour as opposed to by a percentage?
Yes, you could do a plan, usually for a flat rate.
A flat fee.
A plan is usually a flat fee of several $1,000s because it's a long and involved process. But absolutely get the plan, and then you can decide. You could find somebody by the hour or find somebody for a percentage. Either way, thanks so much for the call. If you guys want to get in touch with us, it's real easy. Just go to talkingrealmoney.com.
The opinions and views expressed on this podcast were current on the date recorded. Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions. Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy. Information presented on the podcast is not personalized investment advice from Appella Wealth. The views and strategies described may not be suitable for everyone. This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction. Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appella Wealth, a fee-only registered investment advisor. Please see Appella Wealth's ADV Part 2A on our website for information regarding Appella's fees and services. Appella Capital, LLC, DBA Appella Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appella does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. And the lawyers get richer.